So we're going to come back to talk about superannuation and in particular your end of financial year strategies.
Yeah, so last time I was on, we spoke about the potential changes with super that were announced in the budget. So there's a couple of other quick things I just wanted to cover off there, which I didn't get a chance to do. Last time I was spoke about pre-tax contributions, but there is a change to after-tax contributions that are coming up. So what it basically will be is that there's a lifetime cap of 500,000 of after-tax contributions that you can put in, and the interesting thing is that they'll count back from 1 July 2007. Those contributions that have gone in. So it's just something to be wary of, and I guess people that have done that in the past just need to review what you've put into super so far, so that you don't breach that cap.
Yeah.
So
okay, because if you breach the cap, there's tax.
Yeah. And 500,000 might seem like a lot, and which it is, but a lot of people might have a strategy, for instance, of potentially selling maybe an investment property, or something like that, and wanting to get that into super prior to retirement because it's a tax-effective environment. So
right,
just things that just need to be wary of that. Whilst these changes are proposed from 1 July 17, because this one in particular, they will look back from what contributions have been made since July 2007. So,
and are these changes that are proposed, is the budget that comes out tomorrow going to have any relevance to that? Like, are these or a change in government? Does that mean that these proposed changes may never come to fruition?
Yeah, definitely.
Far out.
Yeah, that's the life that we live in. But
that's right.
Yeah, but if things stay the same, Liberal government stays in, and these pass through the government, then they will come into force, and a lot of them are from 1 July 2017. But it's just things to be aware of. So
would you expect there'd be other amendments made from the budget, or the budget's irrelevant to the superannuation space?
Quite possibly.
Yeah.
It's anyone's guess, really.
Okay,
but, not 100% sure. But, a lot of the announcements in the budgets don't even come into fruition. A lot do, but we'll just have to wait and see. So
yes, because one thing to plan it and put it out there that we want to do this, but then it gets blocked, doesn't it? And sometimes they don't always come through.
Yeah. But
people forget
it's
that.
always the reason why I'm talking about this in this segment is that it's good to be aware of that it could come up, and you don't want to be penalised down the track if it does come into play.
Yeah.
So the other interesting thing too is that one of the positives of the changes that they're proposing is that people from 65 to 74 will be able to contribute to super as well, no matter if they're working or not. So at the moment, you need to meet a work test to be able to contribute money into super in that age bracket. So
why is that? Why do they have that restriction?
Oh, well, I mean, to me, I think it's a silly restriction.
Oh, it is a silly
So
restriction.
if I was working and I was age 65 and working, my employer doesn't contribute, or I'm not allowed to contribute?
Fine. No, you can if you're working at the moment, so that's not a problem at all. It's just if you're not working.
So if I was not working at age 65 and say I had investments coming in from other avenues, rental properties or whatever, I can't put that into my super?
That's correct,
Right.
But it will. Well, the proposed change is that you will be able to do that in the future. So, which
weird,
I think
because it doesn't make sense, really, because you're just preparing for your future. And why they would
maybe
have
they
that
think the
restriction
future's
on it.
here at 65.
God, I don't know.
Yeah, so that's probably one of the positive things that
Yeah.
they've increased that age. So that's a good thing. Another thing too, and the last point in regards to the proposed changes, it relates to what's called a spouse contribution tax offset. So at the moment you can contribute contributions to your spouse, and if your spouse is earning less at the moment, earning less than about 10,000, what is it? 10,800, then you can actually get a tax offset. So they're actually increasing it now so that the threshold will be 37,000. So if your spouse is earning 37,000 or below, you can contribute to their super and you'll get a tax offset.
So if I was the main income earner in the house earning 100, 150 and my partner was stay at home or part-time, say, so I could actually contribute into super on their behalf.
Yep. So it's up to get the maximum offset, it's $3,000 that you could put in, okay, and then you would be entitled to a tax offset of $540.
Okay.
Okay, so
by putting $3,000 into my spouse's.
Yeah.
superannuation who was earning less than the threshold.
Yeah, so at the moment it's 10,800. So there's a big,
Yeah.
it's a large
Yep.
increase. So it'll
Yep.
just be open to more people.
Because
basically.
10,800 is not even, I mean, that's lower than the tax-free threshold. So
so it's not open to as many people. But,
Yeah.
this will increase.
But
that.
37,000 would be quite, if you look at quite often where you have a main income earner and a part-time earner sort of, looking after the family as well, then if you're fortunate enough that you've got that demographic in your household, then often the part-timer is only earning.
Yeah, exactly. And so it's a good way to increase their super. Okay, because they're not, their super isn't accumulating as much, and then you can also get a tax offset.
tax offset
So,
for it.
Yeah, so that's obviously a good thing as well. So, yeah, those changes and obviously the ones from the previous segment are the major.
Do you want to just recap on those for us while we've got you? Do you remember?
Yeah, of course. So there's changes to the what's called the concessional contribution cap, so the pre-tax contribution. So it's going to be dropping down to $25,000 for everyone. Okay, so at the moment it's 35 for people above 50 and 30,000 for below 50. So a fairly significant decrease there.
In age?
Yeah, in
That's
age.
that you're talking, yep.
Yeah, so proposed changes that everyone, the limit will be 25,000. So that's a negative in my eyes in terms of the changes.
A limit of what you can contribute?
Yeah.
Right.
Yeah. So that was one of the ones we covered off. And I think I just spoke about last time the fact that there'll be a higher contributions tax. The contributions tax will increase to 30% for people earning over 250,000. So at the moment it's 300,000. So I think that were the main ones that we covered off last time.
I tell you, it just, for me, it just reiterates how important it is to have a relationship with a financial planner, particularly in my world, as you know, brokers, and we have a very similar business to Rob, but understanding this part of what's so important in people's lives, it's forever changing. And I think that the expectation from a lot of, I had a very good conversation with a couple on Friday and sent them off to financial planning for that very reason, because there was a whole bunch of stuff that do we sell this property, we want to, and this is where we want to end up, but they're sort of heading into retirement age and they're sitting on some super. There was and I literally said, you know what, I can help you with putting anything in place that we need to, but you really need advice, because, and the other thing that I encouraged them to consider was that if I said to you, give me $2,000 and I'll turn it into 10, people would jump at that opportunity, but they tend to shy away from paying for advice when it comes to their financial situation. And I don't understand. You're always going to end up in a better position. And if you don't necessarily end up in a better position, you actually know that you're in the right position. So that's valuable too.
Yes. Absolutely.
I really struggle with.
Yes, I hear what you're saying.
My hat off to you, because I think it's a hard gig. I think that your knowledge is forever changing, and I think it's something that people really do need. And like I said, I think the hardest thing is just getting people to understand that, man, I just cannot keep up with the changes.
Yeah. I mean,
it's a minefield.
Yeah. I mean, if it's sticking into the topic of super, I mean, because of all these changes that people are hearing about, they get scared.
Yeah.
That's too hard. But it's still a very good environment for your retirement savings. Probably it is the most tax effective. So
yeah. And it's just having someone talk to someone who has the knowledge that you have, because you can say exactly that. Well, if we do this before 1st of July, you're going to benefit in that way. If we wait till 1 July, you're going to benefit in that way. That's gold. That information is gold.
But maybe because there are fees up front, isn't there, for financial advice and things like that, and that's different to, say, your industry and the banking industry, where the fee is done through providers, where we all know of stories of people who have been, financial planners that weren't very good or pushed on a certain product, or, you know what I mean? Like, I suppose that there's caution there. And
but
probably
I think those things happened where
scary.
it was commission based. They had a lot of regulation that went through the financial planning industry.
There's been a lot of changes with that. So it's a lot more transparent in terms of fees and what you're going to get for the service.
Yeah.
But people have had that experience, of course. But
you get good and bad in anything.
That's exactly right. And the difference that a financial planner can make to someone, a good financial planner, it's just huge. But there is that negative perception out there, unfortunately. But the ones that do take the plunge, and not only just get that initial advice, but also that ongoing relationship.
Yeah.
You know, coaching them along the way, making sure that they're making the right decisions.
Well, because as you've clearly pointed out, stuff changes.
Things change, and
Yeah.
you know, if say for instance, the performance of it hasn't been that good for the year. I've talked to a lot of people that have pulled the plug at that point in time and changed their investments around, and that's been really detrimental to them because you know, markets do recover, and so there is a lot of value in getting that ongoing
100%.
service
I agree
from
with
an
you.
advisor.
Thanks, Tim, for coming in today.
Thank you, Tim.